everyone. Today here we are at Studio 17 inside Florida Insurance Agency. We're recording episode number 2 with Reliance. And we have Kaila here with us, and we're going to talk about the all-in-one program. Last time we finished off and we promised everybody that we're going to come back and record a whole episode in regard to this beautiful program. First time I hear about it, before we got on air, we had a little bit of discussion, and till now I'm still processing a lot of great questions and great idea. So Kaila, thank you for joining us again.
Yeah, thank you for having me.
And again, today we want to reconvene and talk about that beautiful program that Reliance has. And apparently you guys had it for 20 plus years.
Yeah, so Reliance Mortgage is backed by CMG, which is one of the top lenders in the nation. And so Chris George, our CEO, actually founded this program in 2005, and it is what brought him into 50 states. And we are incredibly proud to represent this product, the all-in-one loan. His son, Harrison George, this is the only thing that he sells. And it does take a lot of education, but it is worth it because we really feel like we are wealth builders. And so it's one thing to just sell you a mortgage. We don't want to just sell you a mortgage. We're selling you on the power of home ownership. And what does that mean? It really means building wealth and stability for your family and future generations.
Wow. Trying to see what question I want to start with because I have so many right now. So again, this is another type of loan that's related to real estate.
Correct. So when you think about loans, there's 2 categories. There's the qualified mortgage and the non-qualified mortgage. And non-qualified mortgage are just, I like to think of them as unique. And so what do I mean by unique? Well, we have non-qualified mortgages for self-employed borrowers who need a bank statement loan, or we need a 1099 loan, or we've got a unique property like a condo with a leasehold. We do a lot of those here on Pensacola Beach. And we need a non-QM product. And all that means is that there's an investor out there that is taking a greater risk to lend you money. And so a qualified mortgage is our traditional, conventional Fannie Mae, Freddie Mae, FHA, VA, USDA. We do all of that. And actually the all-in-one loan, even though it is a non-QM, you are qualified on the same standards as a conventional mortgage based on the Fannie and Freddie guidelines.
Okay. So again, it's called all-in-one.
Yes, the all-in-one loan, you can find it very easily on allinOneloan.com.
Okay. And is that specific to Reliance Bank or other institution offers it?
Specific to us. So there have been other banks that have tried to do something similar. And what I mean by that is they'll offer a first lien HELOC, but we have not found one that offers a line of credit on your home for 30 years. So when we think about lines of credit, they're traditionally second liens. So what makes this unique is it's a first lien. Secondly is the length of time you can draw from the line. Most people have a period of 5, 10, maybe 15, or even 20 years, but none go up to 30 years like ours. They all convert to a fixed payment within that time frame.
Okay. All right. So let's dive in a little bit more into the program. Again, I'm hoping we can actually achieve all of the questions in one episode.
Yeah.
But now I feel like we might have to do a second episode for this program.
Yeah.
So in a regular mortgage, 30 years fixed, right? A lot of times you have interest and, principal payments into the loan, plus it depends PMI and, escrow and all of that, right? Whenever I was talking to you about this program, it sounded a little bit more interesting.
Yeah, it is. We break up the mortgage payment, and we do that to benefit you. So it's all about you actually having control of your money and using it to offset your expenses, the biggest expense being your interest expense.
Sure.
And then you will have insurance and taxes. We do require that you have insurance on this home. But the benefit by not escrowing is that when you're not paying those bills, that means that money that you're saving for those bills is offsetting your interest expense. And we do have, if you borrow up to 90%, so between that 80 and 90%, there is a PMI, but it's an upfront cost. So it's not in your traditional payment. And so we do essentially kind of deconstruct what is the traditional fixed mortgage payment. And all of that is geared to save you interest dollars for the life of your loan.
Okay. While we were talking again before we got on air, you had some scenario or synopsis that you did yesterday. Do you want to talk a little bit of that example?
Absolutely. I love using real people, real numbers, real stories. And that's where I like to get started because it is a hard concept to understand. Trust me, this actually got me into mortgage. And it took me, I had to sell my own colleagues on it. And they now actually have this product and used it to buy an investment. So I love using real life stories. So yesterday I met with a client of mine and so these particular individuals have Social Security income as well as retirement income. And that is the income we are using to qualify them on this loan. And so when you take in income, you offset that by your liabilities. And they said, our goal, Kaila, for this loan, this refinance, we've owned our home for 30 years. Just for reference, they only owe $12,000 on their home. And this was from another refinance they did years ago. So they've owned their home for 30 years. And they said, we need new windows. It's about a $25,000 expense. But if we're going to do this, if we're going to refinance and take out some money, what we'd like to do is also pay off some other debt. And I said, absolutely. Let's look at that. And so we looked at their debts, I think all accumulated to about $60,000, and that includes the payment for the windows. Our minimum cash out on this loan is $100,000. And so what that looked like was getting $100,000, paying off the debt immediately. So immediately their monthly expenses go to zero outside of eating and power bills and things like that. And their windows are fully paid for. And then when they get access to the line, they would just drop that excess cash right back in it. But once they started learning about this product, what they decided to do was, yes, they're going to take out that minimum $100,000 cash out, but they're going to write the line for up to 80% of the value of their home. And the reason they're going to do that is because they don't intend to finance another thing for the rest of their life. What does that look like? So they're going to have a $340,000 line of credit. If their home, appraises for $425,000, that's our projection. We can adjust the line, the note. And so why do they want that line of credit? Well, it could be for unexpected medical expenses. We talked about maybe funding the grandkids' college or some investment accounts, CDs for the grandkids, because they do want to leave their kids something. Their biggest concern was, I don't want to leave my kids in debt. And so what happens when I pay this down? And so we talked about what does that look like, but I'll bring it back to, let's just say we just do the car, the boat, the windows, the credit cards, and we pay that all off. How long is it going to take them to get back to zero? Only 2 years. And the other thing is that we compared it to a traditional cash out refinance, a fixed loan. They would have had to have gone and found a loan for 2.586% to beat the all-in-one loan, or really to match the all-in-one loan. Lower to beat it.
I don't think they exist right now.
It doesn't exist. I mean, unless, your sister is going to loan you money for 2.5%.
Private loan, yeah.
So they're going to be debt-free in 2 years if they change nothing about their life. And one thing that I've found with Social Security is you typically get a cost of living increase every year.
Sure, absolutely.
And they're actually going to have some future retirement accounts that start flowing back into their banking system. So let's say they kick on their retirement account, I think it was called a TSP, next year. And so they flow more money into their system. Well, they're going to beat the projection, right? They're going to pay it off in potentially less than a year, but let's just call it a year and a half. And so then they still have this line of credit. And that's when I said, when you get to that point, I encourage you to use it to continue to build wealth. And we can talk about what that looks like. You can meet with your financial advisor. Those are the types of things you should do. Why? Because your home should be an asset. And this is one of the ways that we can do it to help you build wealth, not just for you, but to leave for your 3 kids and their kids and so on.
Sure. So another question. Yeah. Let's say currently I own a house. I owned it for 10 plus years. A lot of people took a second mortgage or a line of credit, right? Yeah. Can I combine the line of credit and the first mortgage into that all-in-one?
Oh, absolutely. Yeah. So when we run projections, we'll actually run projections against your current. And so the current can include the second mortgage. So we're going to run numbers all day long. And look, if your projections aren't positive, it's going to pop up right on the screen. It's not me selling you anything. It's going to tell you if you're saving money or if you're not saving money. Very rarely do I find you're not saving money unless you're really living almost paycheck to paycheck. That is where this can be challenging to help you beat, your results.
Correct.
But then we can put a plan in place because most people, like I've got somebody right now, they want this product. And we are working a strategy to pay off certain debts to where then we can get to the point where we can reconsolidate and then they can continue to snowball their debt down with this product. So that is one of the things we'll do is we'll take a look at exactly what you have right now. And we're going to talk about what that looks like consolidating.
Okay, so earlier we were talking about an example. Let's say if I make $4,000 a month. This is my salary income.
Right.
And I have a mortgage. And let's say I have a mortgage for $1,500. Now, one thing that I caught from you earlier saying that the minimum I will have to pay, correct me if I'm wrong, is probably just the interest.
That's your actual payment. So people get really wrapped up. What's my payment? What's my payment?
Correct.
And so we need to think about our payment in two ways.
Okay.
Every time we get paid, and most of us get an ACH if we're getting, a paycheck.
Correct.
That is a principal payment. And right now, when you make your mortgage payment, you make it once a month and you're paying all at the same time, principal, interest, taxes, and insurance.
Sure.
When you get your paycheck in this loan, it is just a principal payment. And so you are making a payment if you get paid twice a month. Let's say you have a partner, and so you're both getting paid twice a month. That's 4 principal payments that you made in a month. Let's just say it's one person.
And none of it goes towards the interest, so I'm not wasting any money. It's all 100%.
100% to principal.
Wow.
Yeah.
Wow.
So then you do get an interest payment, right? What is that? Well, so we're in February. We have 28 days in this month. Correct me if I'm wrong. February is a weird one.
It depends. Yeah.
This year, I think it's 28. And so you will have 28 individual interest payments that you accrued over the month of February.
Right.
So what your account is going to do is it's going to look back and it's going to say, okay, on day 1, you got charged this. Day 2, you got charged that.
It's a daily interest.
Exactly. It totals it up. And then on the 21st of March is when you are charged that interest. Now, the only time you would need to infuse money, meaning hit the pay button, is if you had maxed out your line of credit and didn't put any money back into the system.
Okay.
When you're utilizing this as your operating account, I like thinking about it like that.
That's a good way to put it.
Just like my everyday checking account, I don't need to hit the pay button because I have line in that credit that's going to cover that interest expense. So that is your true only expense, is that interest that you accumulate every single day. In a traditional loan, your interest is already predetermined.
Correct.
They looked at the 30 years and they said, you will pay us this month, this, et cetera.
Correct.
We're not predetermining it. So let's say you get a bonus. You're going to save on interest immediately when you put, let's just call it a $10,000 bonus. You put that in there, your principal, let's say it was $200,000. Now it's $190,000. So the night before you were charged interest on $200,000. That next night and the following days after till you spend that money, you're charged interest on the $190,000.
So basically, it's like having a savings account that is built inside the equity of your house, and you don't have to refinance for it to get access to that money that you have sitting in that liability.
100%. Yeah.
This is, I mean, that's why I feel like my wheels are spinning. I mean, that can be...
A question I get is people say, why haven't I heard about this sooner?
Correct.
And so I talk about, well, let's think about to 2005, information moved a lot slower, right?
Correct.
And even talking with my colleagues who have been doing mortgages for 30 years, it's a new concept. And so you have to have the time and the energy to really truly hear it. And a lot of times, like you probably know this in our business, like people aren't talking about insurance every day. Correct. When do they care about insurance? When it impacts them.
When it increases or they have to pay it or, oh my God, something is going on. Correct.
And so we have so much going on in our lives. Unless you're just a nerd like me and this really interests you, you are only open to hearing about it when like you need to hear about it.
There's a need for it, correct?
Correct. And so it's one of those things that you have to want to learn about it. And when you do, the light bulb goes off and you go, why haven't I heard about this sooner? And now that I'm in it and I'm actually able to sell this, which I love selling
Sure.
it. I'm not a salesperson, never have been in operations, but I'm passionate about this because it's impacted my life.
You can tell.
Yeah. And so it's like, I'm not selling you anything. You're going to choose whether you move forward, but I'm going to tell you about it because I believe in home ownership, and I believe that you should use it as an asset, and it's up to you to build wealth. And this is a perfect way to do it. So I'm incredibly passionate about it. It's been around. People just haven't heard of it because it takes a minute to fully wrap your head around it.
Okay. So we talked about a lot of different things right now. Just to put it a little bit in a simple term, or what do you have to qualify for the loan?
Yeah, I think that's a perfect next question. So let's say you were going to purchase today.
Sure.
And I use a $350,000 home as an example because that's about our average or median in our local area. So 90% loan to value looks like a loan amount of $315,000.
Okay.
So that means you're going to have $35,000 to put down.
Okay.
So then my loan amount is $315,000. So that means I must have $31,500 in reserves. Now, what are reserves? Reserves can be cash. Reserves can be a stock market account, money market account. They can be retirement, so your 401k, your Roth, etc. They can't be a car.
Sure, yeah.
Correct. Has to be something that can be liquidated. Now, if you're under 65, we can only use 75% of, say, your 401k. So if we have the $35,000 to put down, plus closing cost, and then we have the $31,500 in reserves, the next thing that we're looking at to qualify you is your debt to income ratio. So our back end cannot be greater than 43%. And then the other thing is your credit score. So your credit score must be minimum 700. Depending on your loan amount, it could be minimum 720. So I always say 720 to be safe, but we do have certain, let's say it's an investment or second home or primary, there are certain loan to values. Like, for example, on your primary, if you had a 700 credit score, you'd have to put 20% down.
Okay.
But if you have a 720 or higher credit score, you can put the 10% down.
Okay. All right. Well, another question that comes to mind as well. We're talking about reverse mortgage.
Yeah.
How do we compare this to a reverse mortgage? Because, you hear a lot of senior citizens, that's something that they look at.
Yes.
How is that?
Yeah. So let's just talk about first. I'm not the reverse mortgage expert.
Sure. But we're not doing a,
right. I just like to caveat
overview.
Because learning mortgage, we have a very specific team that does that. But I asked specifically to my team on the all-in-one, I said, hey, what's the biggest difference? And they said, well, for starters, most reverse mortgages, you can get about 35% of your home's value. So let's compare it directly to this. We want to do a cash out refinance. We can get up to 80%.
Wow. Okay.
Yeah. Most people in retirement do have a form of income, Social Security. Let's just say that. So without counting any other income they may potentially have coming in. So with a reverse mortgage, you're not putting any of your income into it. You don't have to pay it. So what are you doing? You're accumulating a debt. You're accumulating an interest debt that will be a lien on your home for whomever inherits it. Now, this is a debt. Let's say you took out 80%, 100%, it's a debt that would have to be repaid, but your income is offsetting that debt. And so you're putting your Social Security, let's just use that as an example, through the system, paying down the debt versus continuing to accumulate.
Sure.
And hopefully what we're doing when we're doing this, maybe they are using it for, let's say, a medical expense, right? But they do have the opportunity to do what they want with it. They could do philanthropic things, but they could also put it in CDs to leave their heirs too. And so everybody's retirement looks different. Everybody's family looks different. Right. I was talking with a friend of mine who doesn't have children. And she does have nephews, but they're very well off. And so she's been talking to me about reverse mortgage. And so, of course, I bring up this product. And we just talk about what does her legacy look like. And she already does a lot of philanthropic things. So this is an avenue for her to use her home that her and her husband built. It's their asset to leave a bigger legacy than she already has a great one, right? But she has other things she wants to do, travel things. And so you can use your home to do that.
Okay. Another question I still have in my mind is, whenever we talked about the $4,000 example, you have to put in all of your monthly income.
So you don't have to. When you learn, you will want to.
Sure. So in a way, so that's, again, what I'm trying to allude to is, but you have access to it at any point.
Right. That's why you can't do it now. So 4% of people pay extra on their mortgage.
Correct.
Why? We know we could pay it off sooner if we pay extra, but why do we do that? Well, we're saving for emergencies, or we should be, hopefully.
Yes.
And we want to live our life. So if I give the mortgage company my money, I can't use it for emergencies or vacations or even investment opportunities. So let's say I want to go put into a syndication, or I want to go buy an Airbnb, or whatever I want to put my money into. If I give it to the mortgage company, I can't use it. So if you're very conservative, you pay extra on your mortgage. Most people don't do that because they know they could go take their money and do else with it. And they've already got this fixed payment that they budgeted for. So it's almost like, let's just set it and forget it. We know we're going to pay that debt. It is what it is. We're going to use our extra money elsewhere. What if you don't have to pick? What if you can have both? And that's what this mortgage lends to, the opportunities within it.
So does it sound like basically combining or eliminating the first mortgage, and if I have a line of credit, all in one?
Correct, yes.
As a line of credit.
Yep, exactly.
That's basically, I guess, is this where the all-in-one verbiage
Got
came?
its name? Yeah. I do think historically, I can't remember what the first name was, but it did get rebranded to the all-in-one. And it's funny because it really is a perfect name. I go to explain it to people. I'm like, the all-in-one. It's the all-in-one. There's no other better way to explain it. It's a principal paid first lien HELOC.
Where the other way around,
paid first.
Yeah, where the other way around on regular loan is interest-based first,
100%.
then principal.
Yeah, look at your amortization table. Yeah. Those numbers don't flip until about midway through. So on a 30-year loan, we're talking about 15 years before you're flipping the script and you're actually putting more in your bank account, essentially your forced savings, than the bank's pocket. And why? Because we know that the average consumer will refinance between 5 and 10 years. So we're only going to make that interest, for those first couple years. And so we're going to front load, right? And I say we, like I'm the bank. Sure. I'm not making that money, just so everybody knows. But, it's the system. And so that's why people are up in arms about the 50-year mortgage, especially real estate professionals, because real estate professionals are in the situation in which they walk into a meeting with a seller and they need to sell. For whatever life reasons they need to sell. And unfortunately, if they got into a product with zero money down, the market's appreciated at a very normal pace, but slower than what they're paying because they're paying so much to interest, they're in a situation in which they don't have enough equity to sell. And that's a tough conversation to have. And so that's why people threw up their arms at the 50-year. But even there's people old school, they hate the 30-year. Yeah. I don't think young people realize that, but I've had lots of conversations. I mean, they hate the 30-year, and it's that same reason. It can put you in a predicament. We thankfully are in a growing market here. So much good happening in our local market. It's really hard to get into that tough equity spot. But with this, you're never gonna, you're gonna already start in a good equity position, and so that really, when you eliminate that risk, that's when you start to see opportunity.
Sure. Now, trying to play the devil advocate, because I just thought of this after what you mentioned. Let's say, God forbid, we never get into that situation and the market readjusts. And you already did that loan all in one. Yeah. And you have access to a line of credit where your value and the equity was high. Yeah. Are you guaranteed at the length of the time, whatever that value appraised for? Yeah.
So I will just be fully transparent. I've never asked this question myself, but let me just talk through how I would think about this as a consumer.
Sure.
You already promised me this. And so long as I'm making payments, because let's take it back to 2008. Had you continued to make your payments, you would have kept your home.
Correct.
The reason people walked away from their home is because they didn't see value in continuing to make a payment.
Their value went down.
When their value went down, they chose to walk away. So I'm going to interpret it the same way. You can choose to use this line of credit knowing that you're borrowing more than what your home is worth. As so long as you're making your payments and you're putting money into the system and you're not getting behind, you're going to have access to that. But of course, if you go to sell, you would be in that predicament.
Correct.
What I will say in turn to that is why I have so much confidence in this product is it's been in existence for over 20 years, survived the crash, grew during the crash, and have been no foreclosures.
Sure. And I guess I just, answered myself as well as you were talking that it is a loan. It is a 30-year loan.
Correct.
Right? So your docs and documents already, you established that value.
Yeah.
Unless you get defaulted on it, there is not going to be a recast of that loan. So the chances are you're probably still going to continue making the same thing.
Exactly. Yeah. And most people make more money in their life, not less. But this is great for people going into retirement who are going to be making less and they want to go ahead and offset. They want to, one, qualify for the most they can qualify for before they lose their income, because that could change their qualifying power. But two, they want to maximize their asset and then pay it down, just have flexibility in retirement. So that's another thing I say. This is a good prep for retirement.
Yeah.
Let's talk about, so in 21, 22, a lot of people refinance.
Yeah.
As they should have.
Yes.
But they're in their mid-50s, most of them. So these people in the next 10 years, now we're already, time's flying, right? We're already 4 years past that. So they're 60. They're looking towards retirement. They have a great rate. They've got a 2.5%, 3% rate. They're not refinancing, but do they really want that $3,000, $2,500 mortgage payment in retirement? So, okay, no, they don't. No one would say, yeah, I want this for the next 30 years. So they're looking at doing a couple things, just using their savings to pay it off. I would suggest they look at refinancing into this because they can achieve a 2 to 3% effective rate. So they're not getting rid of their rate. They're giving themselves flexibility and opportunity in retirement, and they're getting rid of that monthly liability.
Sure, and they can pay it off way faster.
Absolutely. Most people pay it off, in 5 to 7 years. Just depends on your own projections. I've done some projections for people. They're getting less than a 1% effective rate.
Yeah, and it's not for everybody.
No.
Right? I mean, to your point, you have to make the projection with them at first. And if it makes sense and there is savings, why not to proceed with it?
Right. And it's all about your goals. Sure. If you tell me you're going to sell in X amount of time, there's a cost to this loan. So let's do the numbers and see if you're gaining the equity that covers the cost that makes sense to sell, or are you going to invest during that time? Because if not, maybe you sell and then we do this loan. It's all about your goals.
Yeah.
What are you going to do with this money? What does this look like for you? How can we use it for your situation? But yeah, if you're going to sell in the next 2 years, I mean, I don't think taking out any loans, most likely.
Let's say I have the equity in my house.
Yes.
And that $350,000 example that we gave, and we do have that equity. Can I use $300,000 in one check?
Yeah.
Again, there is no limitation on how, where, when.
Wire it, transfer it, write a check. Debit card probably doesn't swipe for $300,000, but you get the gist.
Sure, yeah.
So buy your cars cash. There's no need to finance again. And what I was going to bring up, actually, it just came back to me. We have flexibility. So for our self-employed borrowers, we have a bank statement all-in-one. So we can qualify you based on your bank statement versus your tax returns. That's huge. Because as you know, there's a lot of write-offs for self-employed individuals.
Yes.
I've got like a painter, for example, that I'm working with. And, his taxes look good. They're doing all the right things. But he wants to qualify for a little bit more of a home. And so this year, we talked about you should get with your accountant and your CPA, let them know what you need, what you're looking to qualify for. And you need to look at what your income is versus what you're writing off. Because unfortunately, when you write off all of your expenses, and business owners know this,
sure,
you're just not showing that you're making a lot of income. I had an Uber driver, and we can do 1099 loans. This is kind of a side chat, but they made negative $500. Thankfully, we have a 1099 program, so we could still get them qualified for a home. But if your tax returns show negative, what do you do?
You're not qualifying.
Enter the bank statement loan. So you've got all that money flowing through your account. Obviously, you're making good money. We can qualify you now with your bank statement on the all-in-one as well. So I'm super excited about that.
That is very. Is this just reopened up? Okay.
Correct. Okay. So we just went to our big summit we have every year, and that was the big thing we were promoting, or that team, the all-in-one team, was promoting, is, hey, our bank statement program just launched. So super excited to be able to offer this to more people in self-employed situations.
Wow, this is actually great news.
Yeah.
So we can do 1099.
So 1099 is a different program.
Sure.
So on the all-in-one.
But does it qualify for all-in-one or no?
So on the all-in-one, if you were a 1099, we would still use your tax returns.
Okay.
Bank statement we do have a 1099 program. I just use that as an example because we're in a gig economy, so we have a lot of grocery delivering services,
yes.
Ubers. great. I mean, I'm looking at these 1099s. I'm like, that's great money, you know?
Correct.
And so those people should be able to afford a home. So the 1099 program, if you're filing your taxes and you're writing off your car and your gas and all of that stuff and you show negative income, we can use your 1099. So the total amount of income, average it over the months and get you a number to qualify for. That is not an all-in-one program.
Okay.
Bank statement using your average deposits over the 12 or 24 month period to qualify you, that can be done with the all-in-one now.
Okay.
Yeah.
All right. That's
yeah.
that's good info today.
Yeah.
The other thing that I was gonna ask you, you mentioned something about kids school prepay.
Yeah.
Example.
So again, not a financial advisor, but I'm a consumer.
Sure.
So when I talk to people,
I have kids. You have kids. We all have kids.
Exactly. I'm a consumer. So I'm thinking about, what will I use my equity for? And I try to use it for nothing but assets.
Sure.
I do recommend you live a little. You want a boat, go get a boat. It's like we only live once. You want to take your wife to Japan.
YOLO.
Yeah. You want to take your wife to Japan and have a great time, do that. We only live once. But Florida prepaid, for example, I was looking at this years ago for my oldest son, and I remember there was two costs. There was the cost of finance, so essentially pay a fixed payment over X amount of years, or I could pay all up front, and I think that cost was like overall total $5,000 less. It's like signing up for an annual subscription versus the monthly, right? And so for these individuals, they had so much equity, and they're really well off financially. I was like, you're doing everything right. If this is an opportunity for you to look at, do you want to fully fund a Florida prepaid and then just pay it down over time through your own system versus paying what their, rate is? That's just an idea, and their eyes kind of shot up. I don't know that they're going to do that, but it's just like you can build wealth for your family while you're still alive, and you can enjoy it with your family while you're still alive. And so let's talk about what that could look like.
Sure. So I guess we are at the 32-minute mark. It's a perfect time to actually, adjourn this episode. But I want to give you the chance for anybody that have any questions about the all-in-one program. Call Kaila. Do you want to give them your phone number?
Absolutely, yes.
And email address?
So my phone number is 850-485-3868. And you can call me, text me. My email is Kaila, Kaila .Parker, Parker, at RelianceMortgageLoans.com. And you can find us at RelianceMortgageLoans.com.
Sure.
Type in, we've got information on that website, but also the allinoneloan.com. There's tons of YouTube videos out there. I have a special set of YouTube videos that break it down in a way that I think help people understand. So reach out to me to get that set. It is something you've got to see it to believe it. We have a simulator. We can run your real numbers and talk about what this looks like for you.
Absolutely. At any time, call the professional, call Kaila. She can run projection for you, and then she will let you know if it is something for you. And it will give you a different option, different product. You offer a lot of all of the other programs as well.
Yeah. Oh, absolutely. And one other thing is just this is for primary, secondary, or investment.
Okay. Well, thank you, everybody.
Yeah, thank you.
Until next time.
Appreciate you.